Good morning and welcome to Teachers Retirement System Investment Meeting. Today is March 5th, 2020. Patricia, would you call the roll?
John Adler.
I'm here.
Thomas Brown.
Present.
Natalie Green-Giles.
Present.
David Kazansky.
Present.
Lindsay Oates. Russell Buckley.
Russell Buckley for Lindsay Oates, present.
Thank you. Deborah Penny.
Present.
Susanna Vickers.
John Dorsett for Susanna Vickers, present.
We have a quorum.
Thank you very much. We'll start with the passport funds. We go to Mike Fulvio.
Morning, everyone. We did distribute the quarterly report for the passport funds in advance of the meeting. We weren't planning to go through that with any great detail, given that we discussed performance for those funds at the last meeting. However, I'm happy to answer any questions on the report. And if the board would find it helpful, I could just quickly note again for the record the returns for maybe perhaps what was a really strong fourth quarter and a strong calendar year for markets and the funds. So at the end of last year, the diversified equity fund stood at about $16.2 billion in assets. Again, as I noted, what was a really strong year for U.S. equity markets, up over 31%. It was also a strong environment for the diversified equity fund, up about 28%. Again, what really bolstered returns there was the performance in U.S. equity markets, although non-U.S. equity markets across the board were quite positive, with the International Equity Composite of Variable A and the International Equity Fund both up over 22%. The Defensive Strategies Composite, which you'll note is a 10% component of the Diversified Equity Fund, that was also up over 21% last year. So positive contributions across the board from the different components of the Diversified Equity Fund. And as we would expect, the defensive did not keep up with the U.S. equity markets, or rather global equity markets, but again, hopefully as we look forward to 2020 and see some more volatility, the defensive composite delivers on its intent of providing some downside protection. The Balanced Fund had assets of about $420 million. That fund was up just shy of 11% last year. The International Equity Fund, as I noted earlier, was up over 22%, assets of about $184 million. The Inflation Protection Fund had assets of $75 million at year end. That fund was up just over 10.5%. And the Sustainable Equity Fund last year had a return of about 24%, assets of about $255 million. So if there's no questions on the quarterly, we could move into January. So you'll recall at the last meeting we talked a little bit at a high level about what went on in January with respect to capital market performance, and in particular the equity markets, which represents the vast majority of the underlying assets in the passport funds. The U.S. equity market in January was roughly flat. It was down about 11 basis points. And the diversified equity fund for the month was down about 84 basis points, which was about 40 basis points behind the hybrid benchmark. So though we saw U.S. roughly flat, non-U.S. equity markets were down about 2.5% during January. So that led to as you would see, it contributed, or I should say detracted from the absolute returns of the diversified equity fund in the first month of the year. The Defensive Strategies Composite was up just over 0.5% during January, providing diversification among the assets within the diversified equity fund. And the Active Composite had a tough month for the active managers in that composite, which, as you'll recall, do represent, in a big way, value-oriented strategies, which lagged quite notably during January. The Balanced Fund had assets of $422 million at the end of January. That fund for the month was up 16 basis points. The International Equity Fund, with assets of $180 million, as I noted before, that fund, like the International Equity Composite, down about 2.5%, roughly in line with its benchmark. The Inflation Protection Fund had assets of $74 million. That fund was down about 80 basis points, also roughly in line with its benchmark. And the Sustainable Equity Fund, with assets of $260 million, that had a positive return to the tune of about 2%, about 0.25% behind its benchmark. You'll also note the two new funds which were launched Jan 1, 2020. The U.S. Equity Index Fund, that fund returned negative 90 basis points for the month, and the International Equity Index Fund down about 4% to start the year.
Just a question on that, Mike. These are index funds, so why are they lagging? Obviously, there's very little money in them, but why are they lagging the indices?
Yep. There's so in the unit value returns, you might recall we've chatted about this. It's been some time, but in the past at the board, the unit values do take into account all things such as the timing of cash flows, everything down to trading, administrative fees and expenses. So it rolls up not only the underlying performance of the mutual funds, but also additional factors and different things impacting return. And actually, if you wouldn't mind flipping ahead to slide 9, what you can see included at the bottom of the page for the U.S. Equity Index Fund are the published mutual fund returns for the underlying strategies within those two funds, John. And you can see that the Total Market Index Fund did perform for the month in line. And then within the Total International Index Fund, there is still some tracking there. You can see the negative 330 versus negative 2 3/4. So the difference in the international fund, actually, between the published mutual fund results and the index is due to fair value pricing. Investment managers who more commonly are investing in international equities have a fair value pricing policy so that as investors in the U.S. see that once international markets have closed, U.S. markets continue to be open for some time, and if you see a sell-off, for example, in the U.S., like we saw on the last day of January, managers like Fidelity are actually making fair value adjustments to the marks on the non-U.S. securities in their portfolio for how the implied returns would have been if the non-U.S. markets were open for the exact same trading hours as the U.S. market. So, as you'll recall, in a mutual fund, all participants transact at the end of the day.
Right.
And as a result, you'll see these point-in-time deviations between the fair value valuation on the mutual funds, which impacts sometimes the point-in-time performance, and what the index is showing, because the index shows performance up to the point at which those markets are closing. The mutual funds are more of a fair value representation of how those markets are trading. And what we've seen is over the long term, these valuation differences will they sort of wash out over time. But on a month-to-month basis, you'll see some deviations, particularly in months where there's a lot of trading late in the day, as we've seen over the last couple months.
Okay, thank you for the explanation.
I think if we could also, if there's more questions, we can go into more detail in executive session. So that concluded the update for January. I'll let everyone take a deep breath before we look at February. So I handed out the February report, but I'm not going to spend as much time on it as I will talking a little bit about year-to-date numbers through yesterday's close, largely in part because the numbers are a lot better. And maybe we'll chat a little bit about markets and the volatility we're seeing, and Mike and Alex might jump in as well. So you can see through February, the U.S. equity market at the top of the page was down just over 8% for the month, and about the same return for the calendar year to date. If you roll that forward through yesterday's close, the U.S. market was down 3%, 3.1% year to date, so notably better in the last week or so, as we've seen March start out, I would say just as volatile, but a few up days that were meaningful. In non-U.S. markets, the numbers are not quite as strong as the US, but a little better than what you see for February. So the developed markets represented by the EFI index through yesterday's close is still down about 8.5%. Emerging markets down about 6.8%. Surprisingly, I want to say through Tuesday's close, China was roughly flat year to date, which is interesting, thinking about the dynamics we're seeing. There hasn't been much economic data to this point coming out of China, so a lot of what's been out there is speculation or sentiment related, but it should be about mid-March before we start seeing more information out of China with respect to production. But I think the expectation there is that there will be notable economic impact, not only on China but globally. I'll talk a little bit more about that. Non-US small caps were down a little over 10%, so that's driving some of the more negative numbers you're seeing from the international composite benchmark. And the defensive composite year-to-date through yesterday's close was down about 1.6%. So as you'd expect with the diversification of that composite, the use of convertibles and other more diversified strategies, some downside protection, which is good to see. We're estimating the hybrid composites down about 3% through yesterday's close. So those are the numbers. Where we are today is there continues to be a lot of uncertainty around the coronavirus, what that means not only from a social standpoint, but the economic impacts of that. There's likely to be continued disruption in global trade and global supply chains, which everyone agrees there will be some impact to global economic growth. As I noted earlier, there's not a lot of data coming out of China. We should see something in mid-March, but there was some expectations put out yesterday about potentially a 6% contraction quarter over quarter for China. And the last number I saw was on a global scale that the previously forecasted global growth number was about 3%, and that many are revising that down to a 2% baseline. So we shall see. There'll certainly be more information out there. The markets over the last couple of days have not only been reacting to what the Fed has done and continued news about the coronavirus, but there's also more discussion about what we're seeing in the U.S. with respect to the election, and there's a lot of discussion around how the primaries have driven some of the market returns that we've seen. Perhaps some of that was masked by the headlines around the coronavirus, but we have seen since Super Tuesday some market strength in the last couple days. So it'll be interesting to see how that continues to shake out. But definitely never a dull moment these days.
For sure. Okay. Is there anything else? We're good? Okay. And do I hear a motion to go into executive session?
Sure. I move pursuant to Public Officers Law, Section 105, to go into executive session for discussions on specific investment matters.
Thank you, Mr. Brown. Do I hear a second?
Second.
Great. All those in favor?
Aye.
Any opposed? Okay, we are in executive session. Okay, we're back in public session. Susan Stang, will you report out, please?
Certainly. In executive session, there was a discussion about implementation issues on the pension fund side.
Thank you.
Thank you.
Is there anyone else that has anything else to say? All right. Then do we have a motion to adjourn?
So moved.
Thank you, Mr. Stang. Thank you. All those in favor?
Aye.
Any opposed? Okay, we are adjourned.